Welcome to Swimming with Allocators,
the VC podcast from the LP perspective,
with your hosts, Alexa Benz
and Ernest Sweat. You ready? Let's dive in.
So today on Swimming with Allocators, we're blessed to have Wendy Li. She's a co-founder and CIO of Ivy Invest, making institutional quality portfolios accessible to individual investors. She has a long career as an allocator and former MD of investments at Mother Cabrini Health Foundation, which has over $4 billion in AUM. Today, she's going to share with us how institutional investors approach decision-making and portfolio construction, why early stage venture remains one of the most dynamic and overlooked asset classes today, as well as why emerging managers should understand about preparing to work with institutional LPs. And so with that, I am happily awaiting all the wisdom we're going to get today from Wendy Li.
Hi, Ernest. Thank you so much for having me on. It's delightful to be here and to have this conversation, and I'm really excited to dive into these topics.
No problem. And no pressure from the intro. No pressure on all the wisdom. But I expect it. So I always like to start off on just origin stories of people. And so would love to hear about your own background and kind of how did you make your way into this allocator world?
I did not grow up in an environment in which the broader financial services industry was part of my landscape. I learned a lot about financial services and investment banking, consulting, and investment management when I was at Columbia, our joint alma mater. And it was there where I really had an opportunity to learn about the capital markets and the different participants within the capital markets. But even in that context, at the time, institutional investors and asset allocators and endowment foundations, that still was not really part of what I understood to be the investment world. I think when you are graduating from college and you have the big firms recruiting on campus, those are the ones that tend to dominate the conversation and dominate the mind share. I just happened to be very fortunate as I was graduating that the Met Museum was looking for its first investment analyst. There were a couple of, I think, there's multiple moments in my career which I feel as though it's the universe presented opportunities that were best fit for me in a way that I couldn't have imagined. And I would say that I had envisioned as a senior going down this traditional banking or consulting career path, and then lo and behold, had an opportunity to meet, she's now the current CIO at the Met Museum. At the time, she was a senior investment officer when she hired me, but Lauren Meserve was interviewing, recruiting at Columbia for their first analyst role. And so I had an opportunity to learn about their endowment and had an opportunity to learn about the portfolio and had an opportunity to learn about what endowment foundation management was, none of which really made sense to me, by the way, when I was going through this process. It sounded really interesting. It sounded so different from the other opportunities that I was considering. None of it really, though, truly sunk in until I started at the endowment at the Met Museum. And so that's really, I think, in many ways, I was fortunate that I had my start in this business at a really just incredible from an investment standpoint, but incredible from also a governance standpoint.
Were there any experiences from those early days at the Met Museum that have shaped your perspective or approach as an allocator today?
There are a lot of different things I think I could point to, but I'll highlight two. One of which is a function of when I was starting at the Met Museum Investment Office, endowments foundations were still a cottage industry. And it was still very common for everyone to be a generalist because investment teams were small. These portfolios were smaller, endowments foundations were less known. And so as a function of that, I grew up as a generalist in this business. I grew up with always in the back of my mind this perspective that when you think about the portfolio, when you think about any one investment, it has to be in the context of the overall portfolio and every other investment that is competing for capital within that portfolio. And I think that perspective has always shaped the way that I have continued to invest and the way that I've continued to think about managers, to think about asset classes, the way that I do investment due diligence. And I think that's something that is increasingly uncommon at many investment offices, although I am starting to see a trend sort of back toward that. There's sort of a phase where I think a lot of investment offices have been structured to encourage folks to specialize at sort of younger and younger parts of their career path. And I do think that does a disservice to someone who's coming up in their career and learning about this business and learning about what it is to be an investor, an institutional allocator. So that's one. And then the second piece of it was a function of the timing and the time period in which I was at the Met Museum Investment Office. I was at that Met Museum Investment Office before, during, and immediately after the global financial crisis. And I don't think there's a single person in our business who lived that, who did not have, who was not meaningfully impacted by that.
Yes. Was there one asset class, most of our audience is people who are interested in venture and growth equity, either as an allocator or a fund manager. Was there one asset class that you kind of, even as a generalist, started to lean a little bit towards more of an interest to, or did you have that balanced approach?
I would say that, broadly speaking, I really gravitated toward the private asset classes. And I think there's a host of reasons for that, and venture obviously falls under this category. But within the private asset classes, there are opportunities to make constructive changes in those investments where, when I'm talking, and I'll back up for a second here, what I mean by that is when you think of the various private asset classes, whether it's private equity, whether it's buyout, whether it's growth equity, whether it's venture, you have the opportunity as both, the GP investing into these companies to really shape those companies, to really both control for a venture company, what that capital stack looks like, what the future of that business looks like, and really shape some outcomes. On the private equity side, you have full control of that company. You shape what the balance sheet looks like. You shape what the future lines of business look like. You shape what M&A for that business, if it is a business that has M&A opportunities. Those are the types of strategic, sort of control-oriented possibilities that exist in private markets that I think allow for folks to demonstrate that they have the ability to add value in an active way.
Could you take us to today, and what made you want to create something new? And what problem did you see, and what did you want to... Same question that you all ask us all the time is like, why do we need another, investment firm?
In many ways, there are some parallels to the way I found myself at the beginning of my career entering the endowment foundation world. It was not necessarily where I thought I would go, and yet it was one of those, when I saw it, it was hard to think that anything else could be a better fit. And in that same vein, I had spent over 17 years of my career at various endowments and foundations, truly, one of the most rewarding career paths an investor could ask for. And not one that I necessarily intended to leave, but my now two co-founders in our business is Ivy Invest, my now two co-founders approached me and said, I think the three of us could really tackle a problem that is both a large problem, but also potentially a really exciting business to build. And that problem ultimately, which I think we're not alone in identifying, is that as individual investors, our portfolios look nothing like the portfolios of these large endowments and foundations that I have managed capital on behalf of for a very long time, right? And so that gap is so much wider than I think folks realize. And when you sit in a seat like those that I sat in on the endowment foundation side, it is so apparent, but I think it is really underappreciated among individual investors. And that difference in how institutions invest and how individuals invest, it obviously leads to, at the most basic level, a different portfolio, different investments within that portfolio. But then it also leads to each of these different investments that institutions have access to. They have different potential outcomes that are just for an individual investor that are not available, right? So it's not just the investments, but what are the potential outcomes that those investments can drive in terms of returns, in terms of managing the portfolio through periods like this one, right? It is this function of being able to have a broader set of, let's call it, tools to choose from to build that portfolio.
Can you talk a little bit more about, on both those sides, what are the trends that you feel like is really a tailwind for your business?
I can talk certainly about the GP side, which is enormously interesting what's happening here. And I think if I were still sitting in my seat at Mother Cabrini Health Foundation, for instance, I'm not sure that I would have such an appreciation for the speed and the pace and the scale at which things are changing on the GP side and the asset manager side, in this recognition that wealth channels, whether it's advisors, whether it's individual investors, whether it's through the wirehouses, there is this recognition that there's an enormous amount of capital, and GPs are increasingly looking for ways to tap into that. And the recognition is that capital exists, but tapping into that looks and feels very, very different from the go-to-market motion of approaching institutional investors. They have to be able to solve for questions like structure. They have to be able to solve for questions like educating that end user. They have to be able to solve for questions like, how do you bring the purchaser up to speed? So that's the financial advisor oftentimes. And then ultimately, how do you also bring that end customer, that end investor, client of the financial advisor up to speed? And so you're seeing large asset management firms really devote resources to building their brands, to building educational content around alternatives. And we, Ivy Invest, we get to piggyback off of some of those tailwinds where they're stepping forward and providing a lot of the content, a lot of the education, getting that initial understanding about private asset classes, alternative asset classes, and we get to ride the tailwinds of that. So on the GP side, it's been fascinating when I tell you how many investment managers who, I think if you talked to them 5 years ago, would have said, we're an institutional, we cater to institutional investors, like that's our investor base. And I don't think they would have paid any mind to the possibility of reaching out to retail investors or to the wealth channels. It is just a dramatic shift, truly dramatic shift.
Yeah. And so your model is being this bridge to kind of both these worlds, right? With respects to I don't want to anchor, what have been some of the challenges with doing that, as you've been building this out?
There's a lot of different parts of our business that I think there's moving pieces to all parts of our business. The conversations with the GPs in our portfolio and with GPs that I prospectively am considering adding to the portfolio, those conversations are actually really pretty easy to have. Everybody gets where the world is going, and everybody understands the premise of what we're building and why we're building it and the way in which we're building. I think what oftentimes can be a little bit more challenging for us is, as we think about how do we bridge that gap so that we're going direct to the end customer. We're finding ways to reach out and drive awareness of what we're doing because we're building this direct connection, but we're doing it in such a way that we are the primary interface. We're the sole LP to the GPs with whom we interface and in whom we invest. And our end customer, their experience is really single purchase point, single decision point. Do I want to have a portfolio that expands beyond stocks and bonds and includes all of these alternative managers that they're starting to hear about, because these alternative managers are really devoting, like I said, resources to getting the word out there about alternatives. And so I think the two worlds are coming together naturally anyway, but they're coming together primarily in through financial advisors and through a lot of existing distribution channels. And our business is premised on pulling the two together directly for those folks who are not necessarily today working with a financial advisor.
Now we're going to take a quick break to speak with our sponsor.
Hi, I'm Jeremy Rich, Senior Vice President on the Catalyst 2045 team at SVB, a division of First Citizens Bank. For over 4 decades, SVB has been the financial partner of choice for the innovation economy. We understand the unique needs of founders, fund managers, and investors building in fast-moving, high-growth sectors because we've been there every step of the way. Through the Catalyst 2045 team, we work closely with venture firms and institutional investors to help them grow their platforms, raise capital more efficiently, and unlock new opportunities across the venture landscape. When you work with SVB, you're not just getting a bank. You're gaining a partner with deep sector knowledge, extensive networks, and tools to help you scale. We're proud to support Swimming with Allocators and the people shaping the future of venture.
And now back to our LP interview.
Well, thanks for sharing, Wendy, the kind of nuances of just both sides for you and where you're being a key, asset in the work stream, right, for these investors. I was curious, though, that first going to the GPs, especially the ones who, have said, hey, I'm building for an institutional firm and I'm accustomed to that. Are there any kind of differences that they should be aware of when interacting with you? And what I mean is also your end customer. And how should they prepare for that?
I think one of the reasons that we're really excited about the way we're building our business is I think we really seek to be easy to work with on both sides. For our end customer, who is an individual investor who may have familiarity with other platforms like a Wealthfront or a Betterment or a Robinhood, right? That user experience is something that's familiar to them, and that's very comparable to the user experience that we give to them. So on that side, we really try to meet the customer where they are with a motion that they're used to and a familiarity from a UI standpoint. On the other end of the spectrum, when we interface with GPs, I try to do the same. It looks and feels like all of the other motions that they have had with an institutional investor, because that's who I am. That's how we run our business. We are the sole LP to the GPs. The fund that we manage, or IV Invest is the way I like to describe it, is effectively an endowment in a box. We deliver that box through our technology platform to individual investors, but that box is ultimately actually a fund. And that fund serves as the sole LP to the GPs with whom we interface. And in that motion, it looks and feels like interacting with any other institutional LP. And so really try to make it look and feel really familiar for our GPs too, which helps because most of them have known me for a long time. That's really where we're starting I'm sure as you can imagine, that's really where we started our initial portfolio, is folks I've known for a long time who there's a lot of inherent trust built in that relationship. And you and I know this. This is ultimately, these are not faceless firms. These are people businesses. Investing is a people business. And so much of that is, again, looks and feels very familiar to all the other ways that they've previously interacted with me. I do think that is one thing that sets us apart and why I'm really excited about what we're building. I do think that a lot of GPs, as they start to look to navigate to RIAs and to the wealth channels, there are going to be differences in that experience. Yeah. And I think that is something that folks are getting up to speed on very quickly. And I think the folks who navigate that experience well on the GP side are going to be really successful in those channels too.
One of the things that, talking to a lot of allocators is that should this be seen as a new kind of like staple in institutional capital, or is it just a moment in time? And I think the risk of that is just like the education piece, right? To these different individual families, and the inherent risk that like it's not sticky capital, right, from your LPs. It's not it change based on like, something happened in a macro environment that might have happened yesterday as we're taping this. And so I think your model can actually like have a smoothing out because you are that one LP, like, right? And so I'm just curious, was that part of the thinking as well?
It's something that not necessarily at the outset, because in some ways I was doing what I have known, right? But as I've come to know more of what this side of the world looks like, I do think there is a risk to exactly what you alluded to, is particularly in asset classes where folks are coming in for the first time. I think part of the education component is making sure that there's a real understanding, and I'll just use venture as an example here for, obviously, there has to be a real understanding that venture is a long-term asset class, that real returns and results may not be visible until year 7, year 8, and that is a very, very different mindset. And so what folks are signing up for is, I'm going to invest in this fund today. When it comes back in 2 to 3 years, I have to be able and be comfortable and be willing to underwrite that when there are not yet proof points necessarily from a performance standpoint. And that's really that's for early stage venture, certainly, that has to be the expectation, is the ability to keep underwriting and looking for other proof points that aren't necessarily the types of proof points that you will find in other asset classes, right? And so I think that's really important and part of the education component. I think that both sides can get there. I truly believe that both sides of the market, the GPs and the newer LPs, can get there, but there has to be a clear education component and and I think, Ernest, you and I have talked about this before, it is important to be thoughtful in how you select your LPs as you build a firm. I know it is not an easy fundraising environment. It's an environment in which I think having the ability to partner with the right LPs is going to set someone up for the long term for a sustainable multi-fund firm. Because the last thing you want, and I have seen this throughout my career, is that the last thing you want as you're thinking about building a generational firm is to have one successful fundraise, to go out to market again, and then suddenly realize you have to start all over from scratch. Your existing LPs are not coming back. And let me tell you, that is a almost a harder situation to be in than being a first-time in market fund. Because all of a sudden you have to answer questions about, well, why aren't any of your other LPs returning? You're all of a sudden starting all over again with a different type of, market mapping.
So true. And as all spouses of VCs know, VCs don't have transferable skills. So it's better to be, or that's what I've been told. It's better to be strategic, early on. You've said that early stage venture is where math still works. Can you unpack that for us?
I truly believe this, and this goes back to venture is such a different asset class versus other asset classes. And I really bring my generalist perspective to this, right? When you think about other asset classes, oftentimes the types of considerations are, well, what are the risk return profiles here? What are the possible outcomes? What is the likelihood of generating the potential returns that you're underwriting? And what are the types of outcomes that you might experience? And there's this real consideration that it's better to let an opportunity go than to make a real mistake from an error of commission standpoint, right? Mm-hmm. with venture, it's the opposite. It sort of flips. It's the mindset of, because this is an outlier business, you're looking for outliers. And the biggest error is one of omission, where you miss out on that opportunity. And so from an LP standpoint, we have to understand that it is an asset class with fundamentally a different way of thinking. And our GP should be obviously thinking about things in that outlier model as well. And because venture provides that kind of opportunity, that kind of return profile, I think there's also an element of, well, what sets you up for success to be able to pursue that kind of return profile, right? And so when I think about early stage venture, where we're talking about, let's call it $2 to $10 million checks, and I think a lot of folks have moved in this direction, but I have also long held the viewpoint that ownership is important. So in the early stage, you're writing those $2 to $10 million checks. You're careful and conscious and cognizant about the ownership that you're taking as a result of that. You can then, depending on, assuming that you're selecting companies well and you have some outlier winners in there, you can have successful outcomes that return your fund.
I think like from hearing you, it's clear you have the generalist multi-asset class approach, right? And I think for, my friends who are allocators who are focused primarily just on venture or on privates, they're playing something different because, their mandate is just this asset class. And so, but from your seat, and there are more organizations like you, why do you think there's been such a okayness or going along with, the trend of bigger and bigger fund sizes? Is it because it's just now being considered with other private equity?
So I have several thoughts on this, and I'm going to wade in, and against all my better judgment, I'm going to wade into this with a pretty honest response.
I love that.
Right. So let's talk about what the governance model looks like in a lot of institutions. Depending on the institution, you've got the investment team, of which there's probably somebody who's more focused on privates and venture than other members of the team. You've got a CIO. That CIO ultimately reports into an investment committee. And depending on the institution, that CIO may or may not have discretion over the portfolio. Depending on the institution, the investment committee may have the final, thumbs up, thumbs down, even though if it is a collaborative and well-run investment office, investment committee, that relationship is going to be pretty close, and you're not going to have a lot of surprises. If an investment office CIO is bringing an investment to the investment committee, it's because that's been previewed, and again, assuming that there's a strong working relationship, it's not necessarily going to be the issue. But that said, that's the dynamic you're working within. And there's a second dynamic on the institutional investor side, which is how long is that institution going to be invested with you? But as we said at the outset, this is a people-to-people business. So it's how long is that allocator who's advocating for you going to be in that seat? And if they're not in that seat, is the next person who sits in that seat going to advocate for you? And are they going to have a similar underwriting process? Or are they going to have a different underwriting process? And so I think this is where there's a little bit of, at times, a tension, that tension between, of course, as investors, we want to back folks who are going to be outlier investors, who are going to be earlier stage in that fund, because we know the math typically works better. We've seen the results. But at the same time, we also know that the dispersion of results is much, much wider. And if we get it wrong, that career risk for getting it wrong is much higher.
Whether you're an emerging manager or you're an established GP who's taking over succession planning, a lot of times you don't have that information of how actually these institutional LPs work and what their incentive structure is. And so with that explanation, how would you advise emerging managers to approach institutions like that?
I have two thoughts on this. One is that there's going to be a subset of institutions who have that mandate, who have that buy-in, who have a CIO that very clearly is there for the longer term and has this both interest and willingness, and again, that mandate to invest in this asset class in this way, in the way that they think is obviously best from an investment standpoint, first principle standpoint. Mm-hmm. So those institutions are, I think, I won't name any of them out loud, but I think they are identifiable based on the other GPs that they have underwritten, put it that way.
Yeah.
The second avenue is, for better or for worse, fund of funds. Institutions continue, even well-staffed. Well, I'll step back for a second. I'll sort of answer this a little bit differently. The second is, for better or for worse, fund of funds. Mm-hmm. Even institutions who are very sophisticated, who have long-running investment programs in venture and in privates, some of them still work with funds of funds to identify emerging managers, because there just is such a imbalance when it comes to the amount of time it takes and the dollar size that check that you can write as an institution in those managers that it doesn't always pencil out, right? And so even those institutions that are highly sophisticated might still be working with a fund-of-fund manager to identify those next emerging managers that they want to support. And so oftentimes one of the best ways to get to know an institution is just getting to know the institutional LPs at some of these funds of funds that do back emerging managers.
With that time piece is critical. I remember one of our early interviews, one of the allocators was speaking about how, when I asked them, like, what advice do you give to people who are new allocators, new foundations, new fund of funds, family offices that are interested in venture? And his response was that, like, you need to be okay with spending 80%, he used some big number, of your time to only deploy 10% of your capital, because of like just that dispersion factor and just information, and also it's just so much noise now. Where do you think alpha is going to come from? And you can talk about kind of like, you know, the types of firms and all that, of what you're looking for and what you think LP should look for. But I also, given your experience, I want to hear about, like, what intangibles do you want to see from those firms?
I do unequivocally think that the alpha is going to come from smaller, earlier stage managers. And this is a slight tangent here, but I think what we have seen, and I don't know necessarily if this continues, but I think what we've seen that's really given venture a run for the money is that you have seen that growth equity as an asset class as well. I'm not talking about sort of later stage crossover growth equity, but, you know, growth equity has delivered returns that are comparable to venture within a much tighter band of dispersion. And so if you have an asset class that is lower risk but capable of delivering the same type of returns that you're underwriting for in venture, or maybe not underwriting for, but achieving in venture, all of a sudden it makes it a much tougher case for a venture manager to say that I'm best fit for your portfolio, right? However, if you have smaller venture managers, earlier stage venture managers who are still delivering returns above and in excess of what you can achieve in, let's call it, the larger venture firms, the ones who become, we've talked about this, maybe the closest thing to venture beta there is, even though, right, we know nobody wants venture beta. You don't want venture beta, right? You want...
No.
But let's just use that as a proxy. These larger firms who achieve some degree of, let's call it 2.5x, maybe even 3 at the upper end, which, you know, questionable. growth equity has demonstrated the ability to do so as well with, shorter time frame, different type of downside risk, different type of risk profile. And so I think venture then has to be able to deliver above and beyond that. And that has to be the expectation that folks believe that they can meet with their own funds, right? And so that's one aspect of it where I think the alpha is going to come from these smaller managers, not just because of the math, but also, being earlier stage, you're going to be able to find and really have a differentiated viewpoint. Or you have to have a differentiated viewpoint, like you're forced to have alpha, right? The second piece of it is, actually, I lost my train of thought. Ernest, can you repeat the question? And then I'll get to the second piece of it.
Yeah. So just talking about like one piece was where I think we were talking about and addressed was like what are kind of like the characteristics of the firm is at early stage, and that's where alpha is going to come from. The second piece I wanted to know is like not is the kind of squishy stuff that's critical when you have a lot of competition and noise. And I actually think we're going to see it with our founders too, like the archetype for a successful once in a generational founder when information is all equal, right? For the most part, I think that's going to change. And so what intangibles are you looking for now that will have the major exits in the next 10, 20 years?
So the second point is what are the qualities and the attributes within those types of managers, within that archetype of early stage manager, is going to be able to deliver the type of alpha that you need to see from venture.
Absolutely.
I think going back to venture being an outlier business, it starts and ends in many ways with your deal flow and your sourcing. And again, this goes back to early stage venture is pretty squishy. There's not a lot of numbers that you can fall back on in the way that you can with other asset classes. There's pros and cons to that, right? On the one hand, early stage, you're sort of you're sort of inoculated from what's happening in much of the rest of the world, because what you're expecting, those outcomes are going to materialize in 7-10 years down the road. And so whatever sort of macro backdrop you're investing in, no matter how disconcerting, the thesis is that it's going to have changed, in the time that this fund is going to be investing and generating value. And so that's the positive. The negative is, again, you just have a lot less to grasp onto from a hard, concrete set of data points. Certainly, you can look at an early stage manager's track record as an angel investor, and yes, that's valuable, but it's also, and it tells you a lot about where does their sourcing and deal flow, and what is their connectivity in their network. And I think that's what I'll come back to. But what it doesn't tell you is their ability to construct a portfolio, ability to pick the right spots, ability to be value additive to those founders. Because as an angel investor, those are just not necessarily the things that, it's different. It is different, right? Yeah. And so I think, first of all, that has to be something that early stage managers recognize, that you can't just go in and say, here's my angel track record and expect that to be the end all be all, right? It is a piece of the puzzle. And the other pieces of the puzzle are those other questions around sort of network and connectivity and the ways in which you can help your companies get to that next level, get to that A round, right? So I think so much of it is going to be, does this emerging manager have the right deal flow and sourcing and network and connectivity? And then B, does this manager also have a very differentiated viewpoint? I think you have to have, in order to, as you mentioned, Ernest, in order to stand out from the crowd, in order to really be distinctive, there has to be a very clear viewpoint that you're espousing that is not the exact same viewpoint that I've just heard from 20 other GPs, right? Yes. And in some ways, this is it. Being able to communicate, being able to tell your story, being able to have like a very clear vision for what you're building, and then communicating that clearly. This is not like it's not rocket science. I think this is something that's necessary in a lot of different contexts, and it's certainly necessary in this context too.
Well, I totally agree with all that. And I can see how what you're creating, Wendy, is not only disruptive, but enhancing the market and is much needed, especially with so much new capital coming into the asset class. So I just want to thank you for your insights, sharing all your, your experience from the past at Bigger Foundations, and look forward to part 2, because I know we'll have even more questions when that happens.
This was so delightful, Ernest. I'm glad we had a chance to sit down and chat, and really, really thank you so much for having me on today.
No problem. Thanks for being on Swim with Allocators.
See you later, Allocator.
After Portfolio Tile, Investing with a Smile.